Okay, so let's unpack this. Imagine, right, your business is just booming, and you decide it's time to expand overseas.
Right, a very common scenario.
Yeah, exactly. So you set up this just a tiny subsidiary down in the Bahamas. It's really just a shell company.
Just holding some intellectual property or something, right?
Exactly, just holding some IP while you figure out your next big move. And for the entire tax year, it does absolutely nothing. Zero sales,
Zero revenue.
zero payroll, nothing. And you file your massive U.S. corporate tax return perfectly. You pay millions in domestic taxes, but you forget to attach one specific piece of paper.
Oh, I know where this is going.
Yeah, you forget this one foreign information return for that completely empty, dormant Bahamas shell. And then, like a year later, you get a letter from the Internal Revenue Service.
And it's never a fun letter.
No, it's not. And they aren't even asking for missing tax revenue because, well, you don't owe any. They're simply billing you a flat $10,000 penalty.
Just right out of the gate.
Just boom, 10 grand. And the letter comes with this wild warning. It says, if you don't provide a, quote, substantially complete version of this form within 90 days, that penalty will jump by $10,000 every single month.
Up to a maximum of $50,000, yeah.
Right. Up to 50 grand for a company that did nothing.
It's essentially a $60,000 mistake for an entity that didn't generate a single dime of revenue.
Which is just, it's mind-blowing.
It really is. And, it happens far more often than people realize. The penalty isn't for tax evasion.
Right.
It is purely for failing to navigate the structural demands of the U.S. reporting system.
And that is exactly why we are doing this deep dive today. We are looking into the absolute labyrinth of international tax reporting.
The nuts and bolts of it.
Yeah. Specifically, we are tearing apart the process, the internal controls, and, the documentation required for Form 5471.
Which is the form U.S. persons have to use to report their control of a foreign business entity.
Exactly. And we have a massive stack of source materials on the table today for you. We're looking at the really dense bureaucratic architecture of the IRS itself.
The real inside baseball stuff.
Yeah, including the Internal Revenue Manual, specifically Section 20.1.9 on international penalties. Plus, we've got the exhaustive multi-page instructions for Form 5471.
And a whole web of related Treasury regulations, too.
Right, like Treasury Regulation 1.6038-2.
Which, when you lay all those sources out side by side, it paints a very intimidating picture.
Oh, boy.
Because the U.S. tax code operates on a fundamentally different frequency than the rest of the world's accounting systems.
That's a good way to put it, different frequencies.
Yeah, you are taking these diverse economic realities from Europe, Asia, or South America, and you're just forcing them through this highly rigid, unyielding sieve.
The sieve constructed by the United States government.
Exactly.
So our mission today is to figure out how to actually build that sieve. We want to extract the exact processes, the review steps, and the documentation strategies you need to master this reporting.
To avoid those devastating penalties we just talked about.
Right, because reading through the Internal Revenue Manual, the actual playbook the IRS examiners use, it just feels incredibly punitive.
It definitely reads that way.
It feels like they are just waiting in the weeds to hit you with Activity Code 586.
Which is their internal tracking code for a penalty investigation, yeah.
Right. So it's scary. But how should we actually look at this?
Well, I suggest we flip that perspective completely.
Okay, how so?
While the Internal Revenue Manual is a penalty playbook for the examiner, for a U.S. tax director or a CFO, it's actually a highly detailed, reverse-engineered instruction manual.
Oh, I see. Like a cheat sheet.
Precisely. What's fascinating here is that the IRS is telling us explicitly what structural weaknesses they look for when they decide to penalize a business.
Right. They are literally giving you the test answers before the exam.
Exactly. If they tell us they are going to inspect the foundation for cracks, our job is to just understand how to pour concrete that doesn't crack.
Okay, so we have to build an impenetrable foundation. And you obviously can't pour a foundation in April, like a week before the tax deadline.
No, absolutely not.
To survive an inspection where the standard is substantially complete, you have to start gathering your materials months, maybe even a full year, in advance.
Yes.
Which takes us straight into what seems like the most painful part of this whole endeavor.
Information gathering.
Yes, the raw material.
It is the single most critical bottleneck. Under Section 6038 of the Internal Revenue Code, U.S. persons controlling a foreign business entity must furnish just a staggering amount of data.
We're talking balance sheets.
Balance sheets, post-1986 undistributed earnings, and these hyper-specific logs of related party transactions.
But the tension is that the original data, the source truth in the foreign jurisdiction, is practically useless to the IRS in its natural state.
Completely useless.
Let's ground this in a scenario for everyone listening. Let's say our U.S. parent company owns a manufacturing subsidiary in rural Italy.
Okay, I like it.
Let's call it Luigi's Tractor Parts.
Luigi's Tractor Parts, perfect.
So Luigi's controller is keeping the local books in euros, obviously, and they're using Italian commercial accounting standards.
Yep.
If I am the tax director sitting in Chicago, I can't just send Luigi an email in January saying, hey, what was your net income last year? And then drop that number onto my form, 5471. Right?
Oh, if you do that, the form is instantly defective.
Instantly.
Instantly. Treasury Regulation 1.6038 Kappa-3, subsection A, paragraph 1, requires reporting corporations to keep permanent, accurate, and complete books of account.
Okay, but what does complete actually mean to the IRS?
Well, the standard for those books is dictated by a very specific document in our sources, which is Revenue Procedure 2019-40.
I was reading through that one. It's intense.
It really is. This revenue procedure establishes a strict hierarchy of acceptable financial statements. It assigns codes, from Code 01 down to Code 08, to represent the actual quality of the data you are using.
I found this hierarchy fascinating because it acknowledges reality while still demanding, absolute perfection.
Exactly.
At the very top, the absolute gold standard is Code 01.
Right.
That represents audited, separate entity financial statements prepared in accordance with U.S. generally accepted accounting principles, or U.S. GAAP.
Which, let's be real, is incredibly rare for a standard foreign subsidiary.
Right. Why would Luigi's Tractor Parts in rural Italy pay tens of thousands of dollars to a Big Four accounting firm to conduct a U.S. GAAP audit?
When the Italian government doesn't even require it.
Exactly. They wouldn't.
They absolutely wouldn't. So the revenue procedure forces you to walk down the ladder. Code 02 is audited financials prepared under International Financial Reporting Standards, or IFRS.
Okay, a bit more common.
Yeah. Then Code 03 is audited local country GAAP.
And if Luigi's running a really lean operation and doesn't even have audited financials, we drop into the unaudited territory.
Right. Code 04 is unaudited U.S. GAAP, Code 05 is unaudited IFRS, and Code 06 is unaudited local country GAAP.
And if things are completely informal, like super casual, you hit rock bottom with Code 07.
Which is just the records used for local tax reporting.
Or Code 08, which are purely internal management records, just spreadsheets, basically.
But here is the massive trap embedded in that hierarchy.
Okay, what is it?
The instructions for Form 5471 explicitly state that you can only use the lower codes, what they call alternative information, if the information described in the higher codes is not readily available.
Wait, let me stop you there. Because readily available sounds like a very subjective, very human problem.
It is highly subjective.
If I'm the Chicago tax director and I want Code 01 U.S. GAAP data, but Luigi in Italy says, I don't have that, just use my Code 08 management spreadsheet, how hard do I have to push him?
That's the million-dollar question.
Do I have to force him to reconstruct his entire year of accounting just for my U.S. tax return?
Welcome to the political reality of international tax. The U.S. tax team has to exert massive leverage over foreign controllers who don't report to them and who, frankly, don't care about the IRS.
Yeah, Luigi does not care about the IRS.
Not at all. So you have to build a highly specific, non-negotiable data request list. You cannot just ask for a generic profit number.
You need the raw materials.
You have to demand the complete, unadjusted local trial balance. You need the local Italian tax returns. You need every single intercompany agreement.
Like, what did Luigi sell to the German subsidiary and at what price?
Exactly. The transfer pricing.
Yeah.
You need the general ledger detail for fixed assets so you can completely recalculate the depreciation.
It's like trying to produce a massive documentary film across 5 different countries, all from a desk in Chicago.
Oh, that's a great analogy.
Right. You've hired local camera crews in Italy, Brazil, Japan, and India. You can't just tell them, hey, go film your factory and send me the tape.
Because you get a total mess back.
Exactly. If you do that, Brazil sends you 4K digital video, Japan sends you 35mm film, and Italy sends you vertical cell phone footage.
You can't edit that together into a cohesive movie.
You absolutely can't.
Yeah.
To make the documentary work, you need a universal shot list.
the data request list.
Right. You have to tell every local crew, I need 10 seconds of wide-angle footage shot at exactly 24 frames per second using this specific color profile.
That is exactly how it works.
You have to force Luigi to provide his trial balance in a specific format, mapped to specific account codes, so that when the data arrives in Chicago, it actually fits the narrative the IRS demands.
And, extending your documentary analogy, the biggest friction point with those local crews is the production schedule.
Oh, the timing.
Yes, the timing. Let's say Luigi actually does get a Code 03 audited local Italian GAAP. The U.S. corporate tax return is due in the fall, right?
Right.
But local statutory audits in Europe frequently don't wrap up until July or August.
Oh, wow. So you are sitting in Chicago, your U.S. deadline is looming, and you are entirely paralyzed waiting for the Italian auditors to sign off on the source footage.
You're stuck, which means your U.S. tax team cannot operate in a silo. The timeline has to be managed backwards from the U.S. filing deadline.
You have to plan months ahead.
You have to integrate with corporate finance, local foreign controllers, and local statutory auditors way back in January.
So if you know the Brazilian subsidiary is implementing a new software system in May, that is going to break your data pipeline.
Exactly. You have to account for local holidays, audit delays, and the inevitable weeks of back and forth when Luigi's trial balance doesn't actually balance.
It's a logistical nightmare. But, okay, let's say the data request list goes out. You play the bad cop, you manage the timeline, and eventually the footage arrives.
You finally have the data.
You have a mountain of raw local data sitting on your server in Chicago.
Mm-hmm.
But as we established, the IRS speaks a completely different language.
Yes, they do.
How do we actually translate an Italian trial balance into something the IRS can read without the whole system breaking down?
You have to build a closed-loop plumbing system.
Plumbing, okay.
And that brings us to the concept of standardization and mapping.
Right, because the sources refer to a massive array of schedules. We're talking schedules C, E, F, H, M, O.
It usually gets referred to as an alphabet soup.
Alphabet soup, yeah. But I actually think your plumbing analogy is much more accurate. An alphabet soup implies a bunch of disconnected letters just floating around randomly.
And these schedules are absolutely not random.
Right, they're deeply interconnected pipes. If you pour a gallon of water into one end, it has to flow perfectly through the rest of the system.
Exactly.
Let's trace the pipes, maybe starting with the main intake valves. Schedule C and Schedule F.
Okay, so Schedule C is the income statement, and Schedule F is the balance sheet.
The core financials.
Right. The Form 5471 instructions dictate that these must be prepared in accordance with U.S. GAAP.
So, going back to Luigi's tractor parts, you have a trial balance prepared under Italian GAAP.
And you cannot just translate the euros to dollars and drop it on the form.
That's a huge misconception.
Massive. You have to bridge the accounting standards.
Let's walk through a tangible example of that bridge for our listeners.
Sure.
Let's say Luigi bought a massive hydraulic press for his factory. Under Italian accounting rules, maybe he depreciates that machine evenly over 10 years using a straight-line method.
Right, very standard.
But the U.S. tax code, specifically the Modified Accelerated Cost Recovery System, or MCRS, might dictate that the machine should be depreciated over 7 years using a double declining balance.
That is exactly the type of adjustment that trips companies up.
Because the numbers are totally different.
Exactly. If you just pass through the Italian depreciation number, your Schedule C net income is fundamentally wrong in the eyes of the IRS.
So how do you fix it?
To fix it, your U.S. tax team has to create an adjusting journal entry solely for this tax form. They have to reverse out the Italian straight-line depreciation, calculate the U.S. MCRS depreciation, and input the new number.
But think about the scale of that. If a company has 50 foreign subsidiaries, and every subsidiary has thousands of fixed assets, doing that manually in a blank spreadsheet every year is just a recipe for a catastrophic error.
It is functionally impossible at scale.
So what's the solution?
This is why standardizing your mapping workbooks is an absolute non-negotiable internal control. You cannot have one tax analyst building a custom spreadsheet for Italy and another analyst building a totally different spreadsheet for Japan.
You must have a master template.
A master template is the only way to survive.
How does that master template actually work in practice? Like, if I open the Excel file right now, what am I looking at?
Think of it as an automated filtration system.
Okay.
Tab 1 is the raw data dump. You paste Luigi's raw Italian trial balance exactly as it came out of his local accounting software.
No changes, just raw data.
Right. Then tab 2 is the mapping logic. It uses lookup formulas to say, account 4001 in Italy equals account 500 in the U.S. Master Chart of Accounts.
Ah, so it translates the categories.
Exactly. Then tab 3 calculates the specific U.S. GAAP and U.S. tax adjustments, like swapping those depreciation methods we just talked about.
Got it.
Tab 4 handles the currency translation from euros to dollars based on the prescribed exchange rates.
And then?
And the final tab generates a clean, perfectly formatted output that exactly mirrors the physical layout of Schedule C and Schedule F.
So the data just flows through the pipes, gets filtered, adjusted, and translated automatically.
Yes. And because it is standardized, you roll that exact same template forward year after year.
That makes so much sense.
If an IRS examiner audits you 3 years from now and asks how you arrived at line 4 on Schedule C, you simply open the workbook, and the entire audit trail from the U.S. tax return all the way back to Luigi's raw trial balance is fully documented in the formulas.
It's bulletproof.
Exactly.
Okay, so that handles the basic income and assets. But the IRS is obsessed with how money moves between related companies.
They really are.
That introduces another major pipe in our system, Schedule M. The instructions say it tracks transactions between the foreign corporation and related parties. Why does the IRS care so deeply about this specific schedule?
Well, Schedule M is essentially the IRS's radar system for catching transfer pricing manipulation and profit shifting.
Lot shifting, right.
The U.S. government wants to know if a U.S. parent company is artificially stripping profit out of the United States and hiding it in a low-tax foreign jurisdiction.
So if our parent company in Chicago sells $1 million worth of raw steel to Luigi's tractor parts, the IRS wants to see exactly how much we charged him.
Exactly.
Because if we charged him way below market value, we are essentially transferring our U.S. profit to Italy to avoid U.S. taxes.
Precisely. Schedule M forces you to report sales of inventory, sales of tangible property, and compensation for technical or managerial services.
It tracks everything.
Everything. But the really dangerous areas are what the regulations call platform contribution transactions and cost-sharing transactions.
Wait, unpack that for me. What is a platform contribution transaction?
It generally relates to the transfer or sharing of valuable intellectual property.
IP, okay.
Let's say the operations team in Chicago develops a highly advanced proprietary software algorithm that makes Luigi's hydraulic press run 50% faster.
Oh, that's incredibly valuable.
Right. And they just email the software to Italy. No money changes hands. From an operational perspective, it's just two internal teams collaborating.
But from a tax perspective, Chicago just handed a massive economic asset to a foreign subsidiary for free.
Exactly. And the IRS demands that Chicago be compensated for that intellectual property, usually through a royalty or a platform contribution payment.
Which must be reported on Schedule M.
So
the implication here is huge. The
Okay.
tax team can't just be a group of accountants locked in a basement crunching trial balances.
They absolutely cannot.
They have to be deeply embedded in the actual operations of the business.
They have to know what the engineers are doing.
Right. If the engineers in Chicago share that software in March, and the tax director doesn't find out about it until they're trying to fill out Schedule M the following year, they have a massive unreported transaction on their hands.
The data gathering isn't just financial, it is behavioral and operational. If legal signs a new intercompany service agreement, tax must be the first to know.
That is wild. Okay, moving through the pipes, we hit Schedule E, which tracks foreign income taxes paid or accrued.
Ah, Schedule E. This schedule highlights the extreme specificity the IRS demands regarding currency.
You can't just Google the exchange rate on the day you file the return, can you?
No, you absolutely cannot. The sources cite Section 989, subsection B, paragraph 3.
Okay, Section 989.
This rule dictates that you must translate the foreign taxes paid into U.S. dollars using the average exchange rate for the specific tax year.
The average rate for the whole year.
Yes. And further, you have to attach detailed statements showing exactly how those local taxes were allocated to different categories of income.
It's just layer upon layer of detail.
It never ends.
Finally, we have to talk about Schedule O. This one seems like an outlier to me. It's not a financial pipe, it's an organizational chart.
Right.
It requires you to map out the entire chain of ownership, showing precise percentages of stock owned by U.S. persons. Why is this considered a critical control?
Because your ownership percentage dictates whether you even have a legal requirement to file the form in the first place.
Oh, the categories.
Yes, the Form 5471 instructions divide filers into category 1 through category 5.
Depending on your stake in the company.
Right. Your category depends entirely on whether you are an officer, a director, or a shareholder, and whether you own 10%, 50%, or more of the foreign entity.
So if our U.S. parent company owns 100% of Luigi's tractor parts, we are clearly a Category 4 and 5 filer. We have to file everything.
Right. You're on the hook for the whole form. But corporate structures don't stay static.
Things change.
Always. Let's say the U.S. parent does a minor internal reorganization. They transfer a tiny 2% ownership stake in Luigi's tractor parts to a different, newly acquired domestic entity.
Okay, just a small shift.
If the tax team is just manually drawing boxes in PowerPoint every year to make an org chart, they might not realize that specific 2% shift just pushed that new domestic entity over a 10% ownership threshold.
Meaning that new entity suddenly has a brand new Category 5 filing requirement for Form 5471.
Yes.
And if they don't file it, boom, $10,000 penalty.
Exactly. This is why standardizing your ownership workbooks is just as critical as your financial mapping.
You can't rely on PowerPoint.
No. You need a data-driven spreadsheet where you input the shares transferred, and the system automatically calculates the exact direct, indirect, and constructive ownership percentages.
Based on those attribution rules, right?
Yeah. Right. Under the Section 318 attribution rules, it dynamically flags your filing requirements so human error doesn't cause a missed return.
Okay, so let's recap where we are. We have forced the data through the plumbing. We use our master templates to adjust Luigi's Italian accounting to U.S. GAAP for Schedule C and F.
Check.
We tracked the intellectual property transfers on Schedule M. We translated the taxes on Schedule E, and we verified our filing triggers on Schedule O.
We have numbers on a page.
We have numbers on a page.
Yeah.
But just because the spreadsheet outputs a number doesn't mean it's the right number.
Unfortunately, no.
We have to ensure the logic holds up under IRS scrutiny. This takes us into the third phase, the review process, or as I like to think of it, reconciling the impossible.
I love that phrase, reconciling the impossible, because the U.S. tax code forces you to track metrics that absolutely do not exist in the real world of local foreign accounting.
Right, you're making things up, well, not making things up, but creating new concepts.
You are creating a parallel financial universe.
The sources outline a prime example of this parallel universe. Treasury Regulation 1.964-1 dictates how you conform local profit and loss to U.S. GAAP.
Yes, that's a crucial regulation.
It gives a very specific example, eliminating unacceptable practices, such as including stock dividends as a return of capital.
Let's contextualize that for a second. In a hypothetical foreign country, their local commercial law might say that if a company issues a stock dividend, it counts as income.
Okay, locally, it's income.
But under U.S. tax principles, a standard stock dividend is generally not taxable income. It's just slicing the same pie into smaller pieces.
Right, the pie didn't get bigger.
Exactly. So the regulation explicitly states that these unacceptable practices must be eliminated from the statement, resulting in a decrease in the calculated profit.
So you're stripping away the local economic reality to calculate a purely theoretical U.S. tax number.
That's exactly what you're doing.
And that theoretical number lives on Schedule H.
Schedule H calculates current earnings and profits, or EMP, and then you also have Schedule H1, which calculates adjusted net income for corporate alternative minimum tax, or CAMT purposes.
Let's pause on CAMT for a second, because the corporate alternative minimum tax is a relatively new, massive piece of legislation.
It is huge.
How does calculating CAMT on Schedule H1 change the math we just did?
Well, CMT essentially creates a third set of books.
A third set.
Oh, man. Yeah. You have local Italian GAAP, you have U.S. regular tax principles for standard EMP, and now you have CMT, which applies a 15% minimum tax based on adjusted financial statement income for very large corporations.
You're doing it all over again.
Schedule H1 forces you to start with the net income from the applicable financial statement and make an entirely different set of complex adjustments specifically for CMT purposes.
Exhausting.
It exponentially increases the review burden because the logic pathways are entirely distinct from regular ENP.
But let's stick to the classic ENP on Schedule H, just so we don't lose our minds. What exactly is earnings and profits? Like, fundamentally, why do we care?
ENP is the absolute lifeblood of international tax. It measures a corporation's true economic ability to pay dividends to its shareholders.
Okay.
It is not the same as retained earnings on a balance sheet, and it is not the same as taxable income.
So how do you get there?
To calculate current year E&P on Schedule H, you start with the net income you mapped out on Schedule C, and then you apply a gauntlet of statutory adjustments.
Like what?
You might have to add back certain deductions that are allowed for tax but don't reduce actual economic wealth, like tax-exempt interest.
So we pour our water from Schedule C, run it through the E&P filters on Schedule H, and collect it at the bottom.
Right.
But current year E&P doesn't just disappear on December 31st.
No, it does not.
It flows into a massive historical reservoir, and that reservoir is Schedule J.
Schedule J is where the complexity truly compounds into a multi-generational tracking exercise.
Multi-generational.
Honestly, yes. Schedule J tracks accumulated E&P. This is a rolling historical account of every dollar of earnings the foreign corporation has generated over its entire lifetime, offset by every distribution it has ever made.
And it doesn't just track a single lump sum, right?
Not at all.
Because the sources dictate that Schedule J must track specific, granular buckets of what is called PTEP.
Previously taxed earnings and profits.
Right. Specifically, Section 959, Subsection C, Paragraph 1, and Subsection C, Paragraph 2, PTEP.
Let's translate that statutory jargon into plain English for you.
Please do.
Under certain U.S. tax rules, primarily Subpart F and the Global Intangible Low-Taxed Income, or GILTI, rules, the U.S. government doesn't wait for a foreign subsidiary to pay a dividend.
They want their money now.
Exactly. If Luigi's Tractor Parts generates passive income, like, say, millions of dollars in interest from a bank account, the U.S. parent company in Chicago is taxed on that interest immediately in the current year.
Even though the actual cash is still sitting in an Italian bank?
Yes. So Chicago pays the tax, but Luigi keeps the money.
Okay, so that income has now been previously taxed.
Exactly. The IRS forces you to track that exact amount of money in a specific PTIP bucket on Schedule J.
Why do they care if it's already been taxed?
Because 3 years later, if Luigi finally wires that cash to Chicago as a physical dividend, the U.S. parent shouldn't have to pay tax on it a second time.
I see.
The PTIP bucket proves to the IRS that the tax was already paid.
It's essentially a massive ledger of who owes what and what has already been taxed going back decades.
That's perfectly stated.
And the sources mention another bizarre concept that has to be tracked on Schedule J, the hovering deficit.
The hovering deficit.
That sounds like an accounting ghost story. What on earth is a hovering deficit?
It's a very apt description, actually. A hovering deficit typically occurs during a corporate reorganization.
Okay.
Let's say our highly profitable Italian subsidiary, Luigi's Tractor Parts, merges with a separate French subsidiary that has been losing money for 10 years.
So the French company is drowning in losses.
The French company has a massive accumulated E&P deficit.
Logic would dictate that if you combine them, the French losses would immediately wipe out the Italian profits, reducing the combined company's E&P to zero, right?
But the IRS doesn't allow that.
Of course they don't.
Under the hovering deficit rules, the historical French deficit is not allowed to offset the historical Italian profits.
Yeah.
Instead, the deficit hovers.
It just floats there.
It is tracked in a completely separate quarantined column on Schedule J. It can only be used to offset the future earnings of the newly combined company going forward.
So as a tax preparer, you are looking at Schedule C net income, applying MCRS depreciation to get Schedule H current E&P, tracking Subpart F income to create PTEP, and maintaining a quarantined column for a hovering French deficit on Schedule J.
It is a lot to juggle.
This is an incredibly fragile chain of logic. If an analyst breaks one link, the entire plumbing system backs up, and the form is structurally wrong.
Which is exactly why a robust control environment demands a rigorous multi-tier review process.
You can't just skim it.
You absolutely cannot have a single manager just giving the form a quick glance before filing. Best practices dictate a first-pass preparation by a junior analyst, a detailed second preparer review by a senior analyst, and a final strategic review by a manager or senior manager.
Hold on, let me play devil's advocate here.
Go for it.
If I'm that senior analyst conducting the second-level review, how do I actually spot a hovering deficit error or a misclassified PTEP bucket? Am I literally just sitting there with a calculator, re-adding the columns to make sure the math is right?
If you are just checking the math, you aren't conducting a real review.
because the computer does the math.
Exactly, the software does the math. A sophisticated second-level reviewer is checking the flow of the transaction logic. They are looking for leaks in the plumbing.
What does a leak look like in practice?
Let's trace the transaction. The reviewer looks at Schedule M and sees that Luigi's Tractor Parts paid a $1 million dividend to the parent company in Chicago.
Okay, dividend paid.
The reviewer immediately jumps over to Schedule J. They know that a dividend must be pulled out of the previously taxed P-Tuppy buckets first before it can touch the untaxed accumulated E&P.
Right.
If the analyst accidentally reduced the untaxed E&P column instead of the P-Tuppy column, that is a massive logic failure. The math might technically balance, but the tax result is entirely wrong.
So the reviewer is checking the internal consistency of the story the form is telling.
Yes.
If a transaction happens over on Schedule M, it must create a corresponding ripple effect on Schedule J and perhaps another ripple on Schedule E if Italian withholding taxes were paid on that dividend.
Precisely. The reviewer reconciles the key numbers across the schedules. The ending balance of accumulated E&P on last year's Schedule J must exactly match the beginning balance on this year's Schedule J.
Everything has to tie up.
Net income on Schedule C must logically bridge to the starting point of Schedule H. If those ripples break, the form is fundamentally flawed.
Okay, let's say a listener's thinking, all right, so my junior analyst missed a ripple. A number on Schedule J is off by a few $1,000s because they pulled from the wrong PTEP bucket.
It happens.
It's an honest mistake. So the listener thinks, the IRS will just send a soft letter asking us to amend the return, right? Why should a CFO lose sleep over this multi-tier review process?
Because of the draconian legal standard the IRS applies to this specific form.
The standard is that strict.
The legal standard for Form 5471 is not a good faith effort. It is not mostly right. The standard is substantially complete.
Substantially complete.
And the IRS has a notoriously aggressive interpretation of what that phrase actually means.
The sources outline a Chief Counsel Advice, or CCA, memo. This is internal legal guidance issued to IRS examiners, right?
Right, it tells them how to enforce the rules.
And the CCA explicitly states that if the balance sheet amounts aren't translated into U.S. GAAP, or if the income statements aren't reported in both functional currency and U.S. dollars, the form is not substantially complete.
Let the weight of that sink in. The CCA doesn't say if the taxpayer hid $1 billion in an offshore account.
Right.
It says if the balance sheet is formatted in Italian GAAP instead of U.S. GAAP, the form is legally treated as if it is substantially incomplete. It is as if you never filed it at all.
Which means you instantly trigger the failure to file penalties.
Instantly.
If your multi-tier review process fails and a broken ripple makes it onto the filed return, you have essentially invited the IRS into your house.
You've opened the door.
Which brings us to the fourth major piece of our deep dive.
Yeah.
The IRS examiner's playbook. What actually happens when an IRS agent picks up your case?
This is where we look closely at the Internal Revenue Manual, IRM 20.1.9. It outlines a highly structured, systemic, and relentless administrative machine.
They aren't just guessing.
The examiner doesn't just make up the rules as they go. They follow a strict procedural playbook for hunting down incomplete forms and assessing penalties.
I want to put you, the listener, right over the shoulder of an IRS agent sitting at their desk in Washington. Step 1 in the manual is verify fact of filing.
Right.
The manual says the examiner must first determine if the taxpayer had a requirement to file and whether they actually did. How do they do that? Do they just take your word for it?
Absolutely not. They use forensic accounting techniques based on the data you've already given them.
Like what?
The manual lists their specific toolkit. They pull Forms 883D2, which are entity classification elections.
What does that show them?
This tells them if you previously elected to treat a foreign entity as a corporation or a disregarded entity. They demand the tax organization charts provided during the current audit, and then they demand the charts from the 2 preceding tax years.
Ah, so they are playing spot the difference.
Exactly.
They lay your 2023 org chart next to your 2024 org chart. If Luigi's Tractor Parts is sitting proudly on the 23 chart, but it mysteriously vanished from the 24 chart, and you didn't file a final Form 5471 showing a liquidation or fail, they caught you.
They absolutely caught you. And the manual includes a massive caution flag for the examiners on this exact topic. It literally says in all caps, "Caution. Form 5471s are required to be filed for dormant corporations. See Reverend Proc 9270.
This loops right back to our opening hook, the empty shell company in the Bahamas.
Yes, even if the entity did nothing but exist, the filing requirement persists.
So Reverend Proc 9270, what does that do?
It does allow for a simplified reporting procedure for dormant foreign corporations, meaning you don't have to fill out every single schedule, but the requirement to file the face of the form never vanishes.
So if the examiner spots a dormant entity on your org chart without a corresponding Form 5471, that is an immediate failure to file.
Immediate.
Okay, so the examiner finds the missing Bahamas shell company, or they look at Luigi's Form 5471 and see that you just passed through the Italian straight-line depreciation without a U.S. GAAP adjustment. They've got you.
They've got you dead to rights.
What is step 2? Do they just hit a button and drain your corporate bank account?
No, the IRS is an administrative bureaucracy. They require an internal chain of command. Step 2 is penalty case file controls.
Red tape.
Tons of it. To open a penalty investigation, the examiner must formally submit a Form 5345D or a Form 5345B if they aren't using the ERCS system.
Unpack those acronyms for us. What is ERCS?
ERCS is the Examination Returns Control System. It's the central database the IRS uses to track audits and penalty cases.
Okay.
The examiner fills out Form 5345D, checks a specific box that says Control Penalty Investigation, and inputs rigid tracking codes. The manual explicitly instructs them to use Activity Code 586 and Source Code 99.
Activity Code 586, the mark of doom.
It is the mark of doom.
If I deduce how this bureaucracy works, the fact that there's a specific form for this implies the examiner can't just act as a lone wolf. They need permission.
That is a crucial deduction. The examiner must get managerial approval. The IRS group manager has to review the evidence and physically sign and date the bottom line of the Form 5345D. This proves that the IRS does not take these penalties lightly. It requires supervisory authorization to initiate the financial pain.
So the manager signs off on Activity Code 586. Then the financial pain starts.
Yes, it does.
The examiner prepares and issues what the manual calls a notice letter or a pattern letter. This letter formally notifies the U.S. parent company that they failed to file or that the form they submitted was legally incomplete.
And this letter imposes the initial penalty. For Form 5471 under Section 6038, that initial penalty is $10,000 for each annual accounting period of each foreign corporation.
$10,000 per entity.
Per entity.
If a mid-sized multinational has 20 foreign subsidiaries and the tax analyst used the wrong exchange rate on Schedule E across the board, rendering them all substantially incomplete, that is a $200,000 initial penalty hitting the CFO's desk on a Tuesday morning.
And that is just the beginning.
It gets worse.
The notice letter acts as a starting gun for a ticking clock. If the taxpayer does not provide a corrected, substantially complete Form 5471 within 90 days after the date the letter was issued, the continuation penalties activate.
The 90-day grace period. And if you miss it,
you are hit with an additional $10,000 penalty for each 30-day period, or fraction thereof, that the failure continues.
Up to a statutory maximum of $50,000 in continuation penalties per entity.
Right.
So a single flawed return for Luigi's Tractor Parts can cost $60,000 total.
Yes. And the manual is incredibly pedantic about how they enforce this timeline.
How so?
It states, date stamp Form 547 as they're received in response to the notice letter.
Right.
If such Form 5471 is substantially correct, the stamp date will determine whether the continuation penalties apply.
Wow, it literally comes down to the physical ink stamp on the envelope received in their mailroom.
It does, and the examiner doesn't just blindly accept the new form either.
You check it again.
They are instructed to rigorously review the newly submitted forms to determine if they now meet the substantially complete standard. If you rush the correction and it still has a logic error, the continuation penalty periods remain in effect.
The clock keeps ticking and the fines keep compounding.
Exactly.
This highlights the most terrifying sentence in the entire Internal Revenue Manual excerpt. It instructs examiners to review forms beyond their face for completeness. What does that actually mean in the context of an audit?
This is where the IRS separates the amateurs from the professionals.
Okay, tell me.
Reviewing a form on its face means the examiner just looks at the physical piece of paper or the PDF. Did the taxpayer check all the required boxes? Is Schedule M attached? Does line 1 have a number in it?
It's a superficial check. It looks complete on its face.
But reviewing beyond the face means the examiner leverages the power of the actual audit. They use information and documentation obtained during the examination of your broader corporate tax return to verify the integrity of the underlying numbers on the Form 5471.
They dig deep.
The IRM explicitly states that errors beyond the face are noticed after the examiner has researched your work papers.
This brings to mind the building inspector analogy.
Let's hear it.
Reviewing the form on its face is like a city building inspector driving by a newly constructed house, looking out the window and saying, well, it has 4 walls, a roof, and a nice coat of paint. Looks like a solid house. Pass.
But an IRS auditor does not stay in the car.
Exactly. Reviewing beyond the face means the building inspector parks the car, walks inside, demands the original architectural blueprints, pulls the electrical permits, and takes a literal sledgehammer to the drywall to inspect the wiring and the foundation.
That's a great visual.
If they look behind the wall and see that the wiring is spliced together with duct tape, meaning your underlying work papers are a mess and don't match the numbers on the form, you fail the inspection. It does not matter how beautiful the paint job was on the outside.
That analogy perfectly captures the danger. If the examiner sits across the table from your tax director and says, show me the mapping workbook bridging Luigi's local Italian trial balance to Schedule C, and they see that you failed to make the required MCRS depreciation adjustment, they now know the foundation is cracked.
The gig is up.
The number on the form is structurally unsound. It is substantially incomplete beyond its face, and Activity Chem 586 is instantly triggered.
So if we know the IRS is going to take a sledgehammer to our drywall to look at the wiring, our wiring has to be absolutely flawless.
It has to be bulletproof.
Our historical documentation cannot just be an afterthought. Which brings us to the final and perhaps most enduring piece of this puzzle: documentation, retention, and future-proofing.
Documentation is the only shield you possess when the examiner pulls out the sledgehammer, and the legal sources are unambiguous about your responsibility to maintain that shield.
I found this excerpt from the Federal Register fascinating. It's from TD 8850, referencing the Paperwork Reduction Act notices in 26 CFR Parts 1 and 602.
Yes, the Paperwork Reduction Act.
It dictates that books or records relating to this collection of information must be retained as long as their contents may become material in the administration of any internal revenue law.
Let's dissect that phrase. As long as their contents may become material.
What does that mean in practice?
For a standard domestic individual tax return, people are generally taught that the statute of limitations is 3 years, maybe 6 years, if there is a substantial understatement of income.
Right. Keep your receipts for a few years and then shred them.
So standard corporate document retention policies often dictate that you securely destroy old files after 7 years to save server space and reduce legal liability.
But the rules of international tax completely overwrite that standard corporate policy.
Radically so. Because of the nature of earnings and profits, and specifically those PTEP buckets, previously tax earnings and profits historical records remain material virtually forever.
Virtually forever. Let's trace a deep scenario to prove why that is.
Okay, let's do it.
Let's go back to Schedule J, the historical reservoir of accumulated earnings. Let's say that back in the year 2005, Luigi's tractor parts generated $1 million of Subpart F passive income.
Okay, 2005.
The U.S. parent company paid the tax on that $1 million in 2005 and diligently recorded it in a specific PTEP bucket on their 2005 Schedule J.
Perfect compliance. Fast forward to the year 2026. 21 years have passed.
A lifetime in corporate years.
The U.S. parent company decides they need a cash infusion, so Luigi finally distributes that $1 million back to Chicago as a physical cash dividend.
Okay, so the cash finally comes home.
To prove to the IRS that this 2026 dividend should not be subjected to a second layer of taxation today, you have to definitively prove that the cash originated from that specific 2005 PTEP bucket.
Which means the underlying records, the 2005 Italian trial balance proving the origin of the income, the 2005 U.S. tax return proving the tax was paid, and the continuous unbroken rolling of that Schedule J balance every single year from 2005 to 2026 are absolutely material to the administration of internal revenue law today.
Exactly. If an examiner audits your 2026 return, they have the full legal authority to ask for the work papers that substantiate the origin of the PTIP balance you are utilizing.
And what if you don't have them?
If your tax director looks at the examiner and says, sorry, our IT department's document retention policy automatically deletes all files after 7 years, so I don't have the 2005 transaction logs, you have a catastrophic problem.
The examiner isn't just going to say, oh, okay, no worries.
No. The examiner can simply deny the PTEC classification, treat the $1 million distribution as a fully taxable dividend in 2026, hit you with the tax bill, the accrued interest, and potentially the Form 5471 penalties for substantial inaccuracy.
So when the regulation says as long as they may become material, in the context of EMP and PTEP, they essentially mean until the end of time.
Or at least until the foreign subsidiary is fully liquidated and all historical accounts are permanently cleared to zero.
Practically speaking, yes. You must safeguard E&P work papers, PTIP tracking schedules, detailed records of foreign taxes paid, and the underlying intercompany transaction logs permanently.
Permanently. And it isn't just limited to E&P. The instructions for Schedule I, which is the summary of shareholders' income, require you to track very specific exceptions to immediate taxation.
The source material provides a whole table of codes you have to use for that, right?
Yes. Code SD for securities dealers, code SCDI for same country dividends and interest, and code LT for look-through rules under Section 954, subsection C, paragraph 6.
Let's look at code LT as an example.
Sure. The look-through rule under Section 954, subsection C, paragraph 6, is a vital statutory exception. You're essentially telling the IRS, my subsidiary received a dividend or an interest payment from a related foreign company. Normally, this would be taxable subpart F income immediately, but I am claiming this specific statutory exception because the entities are related and operating under specific conditions.
And the IRS response to that claim is always prove it.
Prove it. The instructions literally require you to attach a statement detailing the exact amount excluded under the rule.
So if you are audited 5 years later and you haven't retained the intercompany loan agreements, the local tax residency certificates, and the exact transaction logs that prove the entities met the statutory requirements for the look-through exception, your claim collapses.
The income becomes taxable retroactively. This is why I constantly tell tax departments that robust documentation is not merely an administrative compliance exercise, it is an economic necessity.
It is the armor protecting the company's cash flow.
Beautifully said.
I want to shift away from the fear of an IRS audit for a second because there is a human element to this documentation. Let's talk about actionable advice for the day-to-day sanity of a tax director. Maintaining pristine historical work papers saves an unfathomable amount of time and political capital within the company.
The operational efficiency gained by perfect documentation cannot be overstated.
Imagine you are a newly hired tax director. You inherit a tax department from someone who was meticulous.
A dream scenario.
Every single Schedule J roll forward is perfectly mapped in Excel. Every major intercompany transfer from 5 years ago has an attached PDF memo from legal explaining the exact transfer pricing logic.
In that scenario, building the current year's Form 5471 is essentially just following a well-written recipe.
You just follow the steps.
You simply plug the current year's raw data into the standardized mapping templates we discussed earlier, verify the US GAAP adjustments, and watch the ripples flow logically through the plumbing system. The review process is smooth because the historical foundation is solid.
But imagine the alternative. You inherit a department where the historical documentation is a disorganized nightmare.
That's the reality for a lot of people.
There are hard-coded, unexplained adjustments to E&P from 2018. The ownership percentages on Schedule O don't match the legal entity database.
In that nightmare scenario, you're forced to spend hundreds of hours acting as a forensic accountant within your own company.
They're pulling your hair out.
You are digging through archived emails just to establish defensible beginning balances for the current year. And if an IRS examiner shows up while you are in that state, the audit becomes an agonizing ordeal.
Because an IRS exam, at its core, is a psychological exercise in trust.
It is entirely about trust.
If the examiner asks to see the bridge between Luigi's Italian trial balance and the U.S. Schedule C, and you immediately hand them a clean, perfectly mapped, standardized Excel file that highlights every MCRS depreciation adjustment with cross-references to the underlying accounting standard.
The examiner looks at your perfectly wired electrical box and says, these people understand the requirements. They have a strong internal control environment.
They trust you.
They gain confidence in your numbers. They wrap up their risk analysis quickly, close the case, and move on to a softer target.
But if you hand them a spreadsheet filled with hard-coded numbers, broken formulas, and zero explanation of how you converted euros to dollars or calculated the hovering deficit,
they lose all trust, they pull out the sledgehammer, they look beyond the face of the form, and Activity Code 586 is initiated.
So if you are a tax professional, a controller, or a CFO listening to this, you have to fundamentally reframe how you view document retention.
It is not just a digital filing cabinet to satisfy a bureaucratic mandate.
Right. It is a proactive insurance policy against future IRS penalties. And it is the greatest gift you can give to your future self when tax season rolls around.
Completely agree.
We have covered an immense amount of ground today, navigating some incredibly dense terrain. Let's synthesize the blueprint we've extracted from these sources.
Let's do a recap.
We started at the absolute ground level with information gathering. You cannot succeed by casually asking foreign controllers for a generic profit number.
No, you must build an exhaustive, rigid data request list that demands unadjusted trial balances, intercompany agreements, and local returns, adhering to the strict hierarchy of Revenue Procedure 2019-40.
You have to manage the timeline like a ruthless documentary director, coordinating global audits and U.S. filing deadlines.
From there, we established the necessity of standardizing that raw data. You must build the plumbing.
Right. You take the chaotic local accounting data and process it through standardized mapping templates, adjusting for U.S. GAAP to accurately populate Schedules C and F, tracking intellectual property transfers on Schedule M, and translating taxes on Schedule E.
And crucially, you maintain dynamic, data-driven ownership workbooks for Schedule O to ensure minor corporate shifts don't trigger missed category filings.
Next, we dove into the crucible of the review process. It's not merely a mathematical check. It is a multi-tier reconciliation of the impossible.
A senior reviewer must trace the transaction ripples across the schedules, ensuring that the net income on Schedule C logically bridges to the current E&P on Schedule H, which then perfectly updates the deeply complex historical PTEP and hovering deficit buckets on Schedule J.
Because if those internal logic ripples break, the IRS Chief Counsel advice dictates that the form is legally substantially incomplete.
This triggers the examiner's playbook in IRM 20.1.9, where agents use forensic tools like Forms 8832 to hunt for missing returns, secure managerial approval for Activity Code 586, and issue notice letters that start a terrifying 90-day clock toward $50,000 continuation penalties.
And finally, the ultimate defense against an examiner wielding a sledgehammer is pristine, permanent documentation. Retaining E&P work papers, Code LT exception proofs, and transaction logs not just for the standard 7 years, but virtually forever. Because in the realm of international tax, the history of a company's earnings is always present.
It is a formidable, highly technical process, but as we've demonstrated by reverse engineering the IRS's own penalty manual, it is entirely knowable.
The government provides the exact specifications of the sieve. It is up to the corporate taxpayer to build a control environment that can pass the data through it flawlessly.
Right.
Before we wrap up, I want to leave you with one final provocative thought that builds on everything we've analyzed today. We have spent this entire deep dive discussing how to standardize human processes.
Right, people building templates and reviewing them.
We've talked about building better Excel templates, running multi-tier human reviews to catch logic errors, and politically maneuvering foreign controllers to provide better data. But the technological landscape of global taxation is shifting violently.
It is undergoing a profound transformation. If we look closely at global trends, tax authorities outside the U.S. are moving rapidly toward real-time, API-driven, digitized reporting.
Oh, totally.
Governments in Europe and Latin America are implementing continuous transaction controls where they receive your raw invoicing and ledger data the exact millisecond a transaction occurs.
Right. So extrapolate that out 5 or 10 years. If the U.S. IRS and foreign tax authorities begin linking their databases in real time, sharing that API data globally, will the traditional reconciliation and review process we just spent an hour dissecting even survive?
It forces a massive paradigm shift. If the IRS already has your raw transactional data globally via APIs, the entire concept of a tax team sitting in Chicago, spending 6 months manually translating an Italian trial balance into a Form 5471 Schedule M becomes completely obsolete.
Are we moving toward a future where the IRS doesn't need an examiner to manually fill out Form 5345D to determine if a form is substantially complete?
Where that determination and the resulting $10,000 penalty is executed autonomously by an algorithm matching global data points before a human reviewer at your company even opens the initial trial balance.
It is highly probable. If underlying transaction data feeds directly into a global government tax engine, the substantially complete standard won't be evaluated a year later on a tax return.
It will be enforced in real time, at the point of the transaction. This means the rigorous control environment we discussed today will have to migrate completely out of the corporate tax department and embed itself directly into the company's frontline operational ERP and invoicing software.
The ultimate building inspector. One that never leaves the house because they are hardwired directly into the foundation's security cameras.
That's a scary thought.
It is an intimidating but inevitable horizon. Something for you to deeply consider as you evaluate your current mapping workbooks and prepare your tax department for the future. Thank you for joining us on this deep dive into the hidden machinery, the staggering penalties, and the intricate architecture of international tax compliance. We hope this extracted blueprint helps you navigate the complexities of Form 5471 and build a foundation that can withstand any inspection. Keep exploring, keep questioning the mechanics of the systems around you, and we will see you on the next one.